Money Roots is made possible by the support of our sponsor, Rooted Planning Group. Are you ready to take control of your financial future? Look no further than Rooted Planning Group, your trusted partner in financial well-being. At www.rootedpg.com, you'll discover a wealth of resources and expertise to help you thrive financially. Rooted Planning Group specializes in personalized financial planning, investment management, and retirement strategies. They understand that every financial journey is unique, and they're here to guide you every step of the way. With a team of experienced advisors, Rooted Planning Group is committed to helping you cultivate a secure and prosperous future. Visit www.rootedpg.com today to learn more about how Rooted Planning Group can help you grow your money roots. Welcome to Money Roots, the podcast where personal finance gets personal. Each week, Amy and her guests dig deep into the world of finance, making it more approachable and understandable for everyone, no matter where you are on your financial journey. From savings and investments to budgeting and planning, we'll bring you practical advice, inspiring stories, and expert insights. We believe that everyone has the potential to grow a healthy financial future, and we're here to help you nurture it. So whether you're a financial guru or just starting to plant the seeds of your financial knowledge, this is the place for you. Get ready to uncover the tools and strategies that can help you thrive financially. So without further ado, let's dive into today's episode of Money Roots.
Hello, and welcome to this episode of Money Roots. This is Kate Welker back again with you today. And today I am solo, so you'll get to just hear me chat a little bit about health insurance. We are in the middle of open enrollment season for many people, and we thought it would be helpful to spend a few minutes talking about health insurance and how you might go about shopping for health insurance or comparing the options. So I'm going to start with employer-sponsored plan at the beginning, and then at the end I'll talk about a little bit about if you are on the insurance exchange instead. And for this episode, we are going to focus on those under age 65. Shopping for a Medicare plan is a little bit more complicated or nuanced potentially, and we're going to spend some time in another episode to discuss that. So if you are ready to dive in and learn more about health insurance or think about how to shop and compare, we'll get started. So your employer will likely send out a brochure this time of year or a summary explaining your options. And under this options, it will list the available health insurance plans. Many employers have several types of plans, and I like to personally compare them kind of side by side. So I have a spreadsheet I use, but you may want to just use a piece of notebook paper, or they may very well, and more brochures do this now, is lay them out side by side for you. The first thing is to look at what type of insurance arrangement it is. Is this a plan under an HMO? Is it a PPO? Or is it an HSA? Those are a lot of letters, so I'm going to back up a little bit. So an HMO, this is a health maintenance organization. If you are under this plan, you are only going to find coverage at a provider within that organization. So they have to be part of that HMO to get coverage. Outside of that organization, there is not coverage. PPO. A PPO is a preferred provider organization. With a preferred provider organization, you have coverage in network, or you could choose to go out of network and find coverage. If you go in network, these are the preferred providers. In network, you are going to find that your copays are lower, your out-of-pocket cost is lower, your maximum out-of-pocket, any deductibles, those are all going to be lower under the preferred provider. The reason being, this is who your insurance company wants you to work with. But there is that safety net of out-of-network options. So if you had something come up and you wanted to go out of network for whatever reason, you could. You have the option to do that. Your insurance will still pay something, but not everything. And it'll be a little bit more than if you went with someone that's in their network. This is a little more, people are more familiar with this when it's seen as somewhat of the traditional insurance. And then the last option I mentioned was the HSA. So this is a high deductible health plan. Actually, I should say high deductible health plan versus an HSA. It's a high deductible health plan with an HSA available, and you may see it as HDHP on your printout. So under this plan, you pay a high deductible, but you are also allowed to have an HSA, which is a health savings arrangement along with this, or health savings account along with this plan. This plan will have a high deductible. The IRS sets limits for how high that deductible has to be. And as a refresher, a deductible is how much money you are paying out of pocket before your insurance kicks in. Now, quite often preventative care is covered at no cost to you. But if you had to go to urgent care, you weren't feeling well, and the bill was $250 to go to urgent care and you had not yet hit your deductible, you're going to pay that $250 out of pocket because you have not hit the X number of dollars the plan has stated you have to spend. After you hit the deductible, then you will go into a copay situation, and it could be a flat dollar amount or a percentage amount. So under a high deductible health plan, you want to make sure you look at how much is that deductible to know what you'd have to pay out of pocket, and just kind of think through your utilization a little bit. So when you're looking between the three options, how do you go about deciding? So if you are looking at an HMO, one thing to consider is this network popular in your area? Do you feel comfortable that you could find providers there? If not, you may want to look at the PPO, the Preferred Provider Organization, or the HDHP, the High Deductible Health Plan arrangement, because it would give you more flexibility and more providers potentially. And then the next thing you want to do is to start looking at those limits. So the first thing is your deductible. I just talked about the deductible on a high deductible plan, but other plans can also have deductibles. So compare across the board, what are you going to pay out of pocket before your health insurance starts contributing partially to your care? After that, this is where you want to dive into what do those copays or coinsurance look like after you've hit your deductible. I mentioned before, they are likely a percentage or a dollar amount. It may be stated as maybe $50 for urgent care, flat copay, or $85 to see a therapist, or it might be phrased as 20%. So if you go after your deductible and the charge is $100, you're going to pay $20. Your insurance company would pay $80 of that. So start looking down through and getting an idea of what would the copays be. Also thinking about yourself and your utilization. Are you using these services regularly? What's it going to cost you? Sometimes you might find that you would be able to hit the deductible on a high deductible plan pretty quick in the year, and it may end up paying off or being cheaper to have this plan. Sometimes we just don't know our utilization. So it's using best guesses and looking at what would be coming out of pocket. The next thing to look at, again, is that in-network versus out-of-network number. Do you have providers in your network in your area, or would they be out-of-network? And then just making sure you're really familiar with what is covered in-network versus out-of-network. So if you do have a situation and had to go out-of-network, you just be prepared in advance, understanding that. If you're making a large change in insurance, something you have not been on before, I do highly recommend calling your providers. If you have very specific people you're seeing, give them a call and just say, hey, I am looking at insurance companies. I have these options. Do you accept this insurance? Then you know. It also gives you that information. So as you're comparing them now, you can say, all right, my primary care doctor or my dermatologist is going to be in network or out of network. The next area I recommend comparing is the prescription coverage. This will be laid out in typically tier 1, 2, 3 drugs and what the charges and the copays will be for those. This is where you may need to do a little bit of research to find out, are you on medication and what are they classified as? If you don't know what they're classified as, you may need to call your pharmacy and just ask, or they actually probably won't know. They may or may not know. Or you could get a prescription listing from the health insurance company that you're looking at. They'll provide you some more information. But as you look at these to understand where are your prescriptions, the other thing could be if you are on a tier 3 drug, is there a generic that you could get on instead that would be a tier 1 if you're getting into higher pharmaceutical expenses to look at too. And then as you go down through, what are the kind of the extra things to consider? Does your employer contribute money to an HSA if you go with a high deductible health plan? This is becoming more and more prominent. And your employer may say, if you go on this high deductible plan, the overall cost is less. So we're going to contribute $1,000 to your HSA for you. I love an HSA as a savings vehicle. The reason being that it is not a use it and lose it situation. So after you decide on your insurance plan, you're going to have a choice between 2 additional ways to save. One is the HSA. The other is the FSA, the flexible savings. Under these, you're able to put away pre-tax dollars to save to use towards medical expenses. The difference being the FSA has a smaller limit, and that is use it or lose it. The FSA is tied to typically the PPO or the HMO, sometimes a lower high deductible plan. Where the HSA is if your plan is high deductible and meets all the IRS limits, you can put money in the HSA instead. This is money you put away pre-tax, but you don't have to use it or lose it in the year. This does roll forward. It rolls forward year to year, and it also is your money. If you leave your employer, you keep that money, and it could roll forward indefinitely until you use it at some point in the future. It does need to be used on medical expenses, not to incur a penalty, but it could be used for a large medical bill in the future. It could be used for health insurance premiums and retirement. There's a lot of fun things with the HSAs that I could go on and on about, but they are a really neat vehicle if they fit you and your health insurance as an opportunity. So look to see if your employer is contributing money. If not, I would encourage you to contribute some money to that flex plan, or the HSA, either one that's going to be eligible to you, just to reduce your taxable bill and use pre-tax dollars to pay for medical expenses that come up throughout the year. If you do have the FSA, you need to make sure that you're using deferring a sum of money that you would actually use. If you don't use a lot of services, have a lot of copays, keep that in mind before maxing out that plan too. And then there may be some other benefits along with the plan. Read down through to see if does it include vision or dental. Typically, these are separate, but sometimes there's inclusions there. Are there reimbursements for gym membership or physical equipment? There may be this sort of section of others on there that you want to look at as well. If you go down through and you're still really confused, reach out to your HR department. They may be able to direct you to some more information on this. Or there's a lot of research online. I know our website has some good, we have other podcasts on this and some blog articles too, just explaining this even further. I am aware that there's a lot of acronyms and a lot of things to compare. But again, like I said, what I prefer to do is sort of lay things out next to each other and look at it and then think through realistically, how many times do I go to the doctor in a year? In an average year, if it's primarily well visits, you're going to kind of look at your base number. What's my premium going to be out of pocket? That may be all you spend in the years if you're healthy. And then you can also look at worst case scenario on your summary. Will list like what's the maximum out of pocket you would spend. This is going to show you a worst case year. You've utilized the plan a lot. You've spent a lot. So that gives you the range of your spending on that. And if you look at your premium plus that maximum out of pocket, that is going to give you a range of where your spending could go, low to high. And again, this is a number you could compare across plans just to help you make a decision for you. All right. Now, if you are not on an employer-sponsored plan, you will likely need to look at the healthcare exchange. Now, this plan is different. These plans are run through our government organization, and they'll either be through the federal coverage or through your individual state. So you will need to learn your state-specific rules when it comes to these plans. And to begin shopping here, eventually it's going to end up very similar to what I just went through in the beginning. But for starting purposes, you will go to your exchange and you'll need to enter your demographic information. So it's going to want to know how many people are in your household, how many people are shopping for insurance, because that is important. It will ask for your county because plans are based on county as well. And then it is going to ask about your income. So I want to spend a few minutes talking about how income impacts you on the healthcare exchange. There is a credit. It's called the premium tax credit. And this is a credit that is calculated on your tax return based on your income. And always kind of be thinking this is a little bit in reverse. So for example, if you get on the healthcare exchange in 2024, you're going to sign up in 2023 for 2024 coverage. Let me use modern numbers. Right now in 2024, you are signing up for your 2025 coverage. They're going to ask you to estimate your income, and they're wanting you to estimate what will happen in 2025 for your income. Because now fast forward to 2026, when you are filing that 2025 tax return, it is going to, you're going to have an extra form to file that is going to show what you paid for health insurance and what your credit was. And then on the tax return, there's a calculation to figure out what your actual credit is based on your actual income, and then reconcile it. So the reason I point this out is you want to try to estimate as accurately as possible, because this will reduce or increase how much you pay for how much you pay for health insurance. And if you underestimate your income when you go to file that tax return, you are going to be back charged for the premium you should have been paying that you weren't. And that is not a pleasant surprise anybody wants to get into. On the flip side, if you overestimate your income, you end up overpaying for health insurance for a year when you may have been eligible for a different plan or a larger credit, pinch your bills. Now, it would come back to you in the form of a credit, but you also, in the meantime, may have been eligible for a different plan through your state. So estimate as best as you can. Also, if you have a change in circumstances at any point in the year, please call your exchange and ask them how that impacts your plan. Because again, you don't want to get stuck with a situation the next year that you're kind of backpedaling and trying to correct. So estimate your income appropriately as you can. I know we don't always know exactly what's happening, but as appropriately as you can. After you do that, it is going to bring up the available plans in your area, and there may be many. You will find that they are staggered by bronze, silver, gold, they're metal level plans. And as these lay out, there will be differences. High deductible plans, some high deductible that are eligible for an HSA, some that are not eligible to save in the HSA. So pay attention to that. Different coverages, as well as different networks. So once you start laying these out, kind of going back to the steps that I laid out initially, as in comparing the type of plan it is, comparing the deductible, comparing, obviously, in the end, the premium. You may find that you get a fairly large credit to offset the premium if you go with one of the less expensive policies. You also will find that typically on the less expensive policies, that the coverage is not as good. So really be careful when you're reviewing those plans. Do the same thing. They will provide you with really excellent links to these plans. So once it might spit out 30 options, you can go in there and click for additional details, and it will bring up a summary of the things I mentioned previously, like what is your deductible, what are the in-network and out-of-network, out-of-pocket maximums, co-pays, co-insurance, as well as links to just this network in general. And then you can go back and start over again and call your providers. It is a lot of work and a lot of comparison. If you do need to shop through the exchange, you may find that there is someone locally through not-for-profit organizations that will help you navigate these websites. This is becoming more and more popular. So I would recommend that if this is something that you are doing and you're confused, see if there's a resource locally that will help with health insurance, signing up on the exchange. And then additionally, depending on your state, if your income is under certain limits, you may be eligible for free or very low cost insurance through that state as well. Example, I'm in New York State, and I know we have this plan called the Essential Plan. It is for those that don't qualify, their income's not low enough to qualify for Medicaid, but it's still considered too high. The state anyway considers it too high to pay for the traditional insurance. So they offer this Essentials plan. And last year they increased the income limits to be eligible quite substantially. So more people are eligible for that. So just take a look at what's available, what's out there if your income would qualify. They do look at household income. So note to self, make sure you are including household income, even if just one person is applying, but there are 2 or 3 people in the household as well. So kind of pulling it all together to go back, first, lay out your options. I didn't add this earlier, but the other thing would be to educate yourself. If you find yourself struggling or unfamiliar with a lot of the terms that are coming up and terms that I just used, as in maybe in-network, out-of-network, co-insurance, copay, deductible, educate yourself a little bit. There's some really great resources online that will just search the terms and just learn a little bit more about what those are and how they impact you. Consider your family's needs. I can compare charts all day, but when it comes down to it, it's also looking at your family and comparing what you need. The other thing that I like to tell people is to make sure that you're really comfortable with the plan. I tend to like a high deductible health plan with the HSA available. And in many situations, it works out better, but it can also be very uncomfortable paying for those expenses up front. So for example, you might pay twice as much for that PPO plan I mentioned earlier, but you walk into the doctor's office and you maybe are paying a $20 or $40 copay or no copay, depending on the plans. There's not that cash flow coming from your pocket. On the high deductible plan, it's coming out of your pocket. So one's more out of the paycheck, less out of the pocket, reverse, maybe less out of your paycheck, more out of the pocket. And it can just be an adjustment for a while. So be prepared for that and make sure it's something that you're okay with and comfortable with. Looking at those out-of-pocket maximums, becoming familiar with what's the maximum that I could spend in the year. And then really looking down through your network, your providers, are they covered? Are my prescriptions covered? I kind of lightly mentioned specialists. If you work with specialists, this is an area I would spend some time making sure that your specialist is in network on whatever plan you work with, and seeing if there would be any kind of referrals needed in the future to work with specialists if you have more advanced health needs as well. Reach out for help. If you are someone that is struggling with this, reach out to resources, whether it be within your place of work, if it's a workplace plan, if it is through a not-for-profit organization in your area that may have some navigators to help you through these plans, or educating yourself more online. Unfortunately, health insurance has become a more complicated thing, and we find some people have some stress and anxiety around picking a plan, but it is necessary at this point in time to have some coverage for yourself. So learning a little bit more. And then on educating yourself after you do have the plan, really educate yourself on what's available. There are really nice reimbursements now for many things. We're finding wellness reimbursements if you utilize a gym or if you buy fitness equipment. Sometimes there's mental health reimbursements if you are using a therapist or seeking out some just work to take care of your mental state. There may be a reimbursement for that. If you are of childbearing years, there are a lot of times reimbursements for either just medical equipment, breast pumps, lactation consultants, different things of that sort that would be available through your plan. So make sure you're not missing out on anything. That's the biggest thing. Take full advantage of this plan you're paying for. Learn the ins and outs. And you also can always call your health insurance company. There is a phone number on the ID card. If you have questions about things once you're on it, after you've made the decision, or if you're on a plan and thinking about switching, there's a number there, and customer service can answer some questions too. So don't be afraid to reach out to them as well. So I wish everyone the best of luck as you're comparing these plans. Hopefully this was helpful as an overview and a rundown of what you're looking at. Any questions? Like I said, seek for some help, seek information, and hopefully you find the best plan for you.
You've been listening to Money Roots, your go-to podcast for making personal finance accessible and approachable. Thanks for joining us today. Amy and her guests have enjoyed guiding you through the roots of your financial journey. Remember, whether you're planting new seeds of financial knowledge or nurturing the growth of your existing financial plans, Money Roots is here to support you every step of the way. Be sure to follow them on Facebook, X, LinkedIn, and Instagram for more resources. And, of course, subscribe to Money Roots wherever you get your podcasts so you never miss an episode. A big thank you to the sponsor, Rooted Planning Group, for making this show possible. At Rooted Planning Group, they're committed to helping you cultivate a thriving financial future. Until next time, keep growing your money roots.